Real estate investing is built and powered by partnerships, and how you structure those partnerships will have a tremendous impact on your portfolio, your returns, your bank account, and your sanity. And in this video, I'm going to walk you through the 5 key must-know things when building and structuring a partnership. And this topic is one that's very near and dear to my heart because when I first started investing in real estate, I made a huge mistake when it came to the partnership I got with somebody, and it nearly destroyed me. It caused me so much grief and hassle, and I got a bunch of gray hairs from it. So my hope is that in this video, by me walking you through all the key steps that you have to take, you're going to avoid all the mistakes that I made early on. So when we talk about partnerships, what is a partnership actually made of? Why would you want to partner with somebody? Well, to answer that question, we have to go to the real estate matrix. And the real estate matrix is comprised of the 4 key components every single real estate deal must have without question to succeed. If one of those pieces is missing, there's no deal. And the first piece of the real estate matrix is the deal itself. Now, you need a deal, you need the opportunity to invest anything. And this comprises of hunting the property, walking the property, knowing what properties to pick, what's going to make sense with your business plan, getting it under contract, the negotiations, the underwriting phase. Is not just finding the property. There's a lot that goes into the deal component of the real estate matrix. Then we need the money to acquire the deal, and this is called the equity or the capital. Some people bring the equity all themselves, other people have to raise the money. It doesn't really matter. You need a down payment, the money that the lender requires you put into the property down on the property in order to get a loan, but also you need CapEx, and this is your renovation budget. So not only do you need down payment, but you also need to fund the renovations that you're going to do to improve the property's physical appearance. Then we have management, right? Because it takes brains to effectively manage and run a real estate investment. We need to make decisions about when to raise the rents, what type of advertising to do we offer concessions, when do we exit, is a refinance better, or do we sell at this point? You need somebody who understands how to manage the deal, how to make sure the capital invested is working as hard as possible. And last but not least in the real estate matrix is the financing. Who's going to source the loan? What are the best terms? What's the best product for this type of business plan? And if needed, who's going to sign on the loan? Who has the net worth that the lender is going to be happy with when they give you the loan? All of those things fall under the financing component. So what does the real estate matrix have to do with real estate partnerships? Well, we know that every single real estate deal must have all 4 of these components, but not every real estate investor has all 4 components all at one time. For instance, you may find a great deal out there and know how to manage that asset, but you don't have the equity, you're not liquid at the moment, and you may not be able to get the financing because of that. So by yourself, you only have 2 of the components and you're missing the other 2. You only have half of the puzzle. And half of the puzzle, it doesn't work. The real estate matrix needs all 4. So in this case, you would then seek out a partner who's able to bring the equity and the financing. So together, your 2 pieces, partner A on this side has 2, you on this side have the other 2. Together, you satisfy the full matrix and the deal can happen. Now, when we talk about partnerships, a lot of people think that it has to be 2 people involved. You have partner A and partner B, but this couldn't be farther from the truth. The fact is, you can have multiple partners in a deal in a partnership type of arrangement. So let me walk you through one example. You have partner A. They are the expert in that market. They have all the deal flow. They know all the brokers. They know what's up. So partner A finds a great deal. But that's all they have right now. They don't have the equity, they don't have the financing, they can't manage it. They just know a good deal when they see one, so they get it under contract. So now they have to seek out people who have the equity. So now they're going to find partner B who can write the check for the down payment and fund the CapEx. So the partner B is going to bring the capital needed, the equity. And now that person, they have the money, they don't have the real estate experience, but they can write the check. So now The duo here is looking out for somebody who's able to finance the property. How can we get the loan so we can use leverage to maximize the returns in the deal? So now they find partner C, who brings the financing. They can sign for the loan, they know all the terms, they can get it. That person acts as the key principal, the person guaranteeing the loan. And last but not least, somebody has to be making the day-to-day decisions. How are we going to raise the rents? What renovations are we going to do? How fast? What staff do we have to hire? When's the best time to exit? All of those questions fall under the manager's role. So they bring in partner D, who's going to manage the entire deal. So together, they each had one individual component, but now that they've partnered together, a deal can happen because all four components are satisfied. Because if one piece goes missing, well, the deal doesn't happen. So everybody knows they have to show up at all times and make the deal work. And this is why partnership is so powerful. Let's say you're working on a deal and there's a very heavy lift component. You have to do some pretty major renovations and construction. Well, that partnership may then seek out somebody with construction experience who can come in and help run the construction component. The team is better off by partnering with that individual because now they can help on the management side of the asset. So whenever you're missing something with your core team, partner with somebody, bring that person into the fold, and the product's going to be better, the investors will be better served, and everybody's going to be much better off because now people can specialize in what they do best. And now that we understand the real estate matrix and how powerful it can be when we get the right people into the mix, let me walk you through the 5 things that you need to look for when partnering with somebody. These are the things you have to consider. And number 1 is, do you like the person? Now, this might sound kind of silly, but all of the most successful real estate investors I've ever spoken with on stage or on interviews on my TV show, whatever it is, almost all of them, they use this as the very first pass. This is the sniff test. Do they like the person? Because if they like the person, chances are they're sharing similar values. How do they value money? What's their value? What's their moral compass? Because everybody's a little bit different. So you want to make sure you're partnering with somebody where you have alignment in terms of how you think about how you manage people's money, your fiduciary duties, how far will you go to make sure people are protected. And this also helps building a foundation of respect because there's always ups and downs in every real estate investment, right? It's a long-term hold, 5, 7, 10 years long. There's going to be disagreements that come up. And making sure that number 1, you like the person, that goes a long way because if you're butting heads right at the start, that's probably not a good sign for when something really goes wrong and you really have to do some pretty serious troubleshooting and have some pretty serious conversations. So by passing the sniff test, you like the person, you have similar values, you get along, you have that foundation of respect, that's going to go a long way for the success of that partnership. Once you've figured that part out, now the question is, well, who controls the deal? How are decisions being made? And this is where you have to give this some pretty serious thought. Do all partners involved have to agree? Or can it be a majority? Or is one person the go-to person for a specific topic? These are all things that have to be figured out up front because you have that whole hierarchy you have to build. Because if you're bringing in investors, they want to know who's making the decisions. Even the partners, when you're bringing people in, how much control do you really have? Is one person running the show? Is there a collaborative approach? And if so, what happens if something really goes wrong and all the partners disagree? Well, in that case, what happens there? If there is that major disagreement, what's your resolution function? Do you go to an arbitrator? Do they have a binding or non-binding decision? Which means, do you have to follow what they say, or can you choose to not follow what they say? Are you going to mediation? Do you have a trusted third party that you explicitly put in the partnership agreement that says, hey, if we have a disagreement, we are agreeing ahead of time that so-and-so will be the decision maker in this case once everybody's talked it over. And in matters of control, you must do the heavy lifting up front. It is not good enough to say, hey, we'll figure this out when the time comes, because that's when temperatures are up. You people may forget previous conversations. You have to figure this stuff out on day 1. As soon as you start talking about the partnership, put it on paper, put it in very clear language, because 5 years later, people forget things. They may not be malicious about it. They may just forget or misremember. But having something clearly laid out on paper, if there's a disagreement, you look at the paper, oh, I forgot we said we would do it this way. My fault. Okay, this is what we're going to do. You will save yourself so many headaches, so many disagreements, so many arguments by laying all of this kind of stuff out on paper in an easy to read format. Talk with a lawyer, they'll help you through it. And then you have to start planning for something that you don't want to have happen, but it could, which is cash calls. And if you're not sure what a cash call is where the property needs an injection of capital, it needs cash, and the property can't produce it on its own, so people from the outside have to bring money in. Now this can come in the form of the partners needing to pony up some money to keep the property afloat. And if that's the case, well, do all partners have to contribute equally? Is one person on the hook for the cash call, maybe the equity partner if it's a single person? How does that work? You have to lay this out in advance. And maybe you have to bring in another party who wasn't in the original partnership. If that happens, how does dilution work? Are all partners diluted equally? If one partner contributes to the cash call but somebody else, does the other person get diluted more when another partner comes in? All of these decisions have to be made up front when everybody's nice and calm and there's no stress, because stress impacts our ability to make quality decisions. So you want to figure out your decision-making matrix and how you are going to deal with cash calls well in advance of that actually becoming necessary. And this is where I really messed up. Shotguns, or at least I call it shotguns. What if a partner stops performing? What if they go silent? What if they stop doing their job and they're impacting the ability to make money? What if they're having a detrimental impact on the running of the property and is jeopardizing everybody else's investment in time and money? How can you remove that person? In my situation, somebody stopped performing and there was no way, because there was nothing in writing saying that you could eject one person. So what happens if that partner stops performing? Is there a vote that has to happen? Does it have to be unanimous amongst all the other partners? Does it have to be a majority? How is that person compensated? Do you have an immediate valuation of the asset or the portfolio and they are automatically paid out from everybody else's share? How does that work? But trust me, you need to have some type of shotgun agreement in there just in case that 1% chance happens, you have a dud in the mix and you have to eject them for whatever reason. Make sure you have something in writing, very, very clearly spelled out. And this is kind of like a bonus tip, but it really, really applies in this case when we're talking about partnerships. And this is front-loading surprises. Just like in real estate, when you're doing your underwriting and deal analysis, you want to find all the hidden red flags and all the surprises up front. You don't want to be in year 5 and have an ugly surprise rear its head. Same thing with partnerships. And a lot of people get nervous about having these hard conversations about control, shotguns. But the truth is, if you have these conversations up front, everybody's going to feel heard because everything's going to come on the table. You're going to have a much better appreciation for how people think, what they value, how they want problems to be resolved. And the fact is, your partnership will be a lot stronger for it because now everybody's working off the same playbook, everything's in writing, everybody's gone through the process, really given all the eventualities some thought, and they've all contributed to how those situations will be handled. This is a lot better way to do things than not having an agreement, not thinking about these up front, and ending up in court. This is where the lawyers win and the investors lose. So to recap, when you're putting together your partnership, do you like the person? Do you get along? Do you share the same core values? Do you have that foundation of respect? How is the deal going to be controlled? Who votes? Who gets to say? Does it have to be unanimous? Figure this stuff out first and put it in writing. Cash calls. Hopefully it doesn't happen, but just in case, how are you going to handle it? Does everybody have to contribute equally? How does dilution work? How do you find somebody if you have to bring in another party with more capital? Figure this stuff out. Make sure everybody is clear and on the same page. And then if somebody doesn't do their job, how do you get them out? Shotgun agreements, and then the bonus, front load all your surprises, have the hard conversations up front, and your partnership will be all the better for it. And in this video, I mentioned underwriting, deal analysis, and this is a huge piece of being a successful real estate investor. So check out this video right here where I walk you through the entire process of underwriting and analyzing apartment buildings. Check it out.